expected, the Fed did not offer any tapering ideas, though we may have to wait until the press conference to find out a little bit more about that. But let's jump to Robert Brusca. He is the chief economist for Fact and Opinion Economics. Bob, it's great to have you back.
It's good to be back with you.
So what's the first thing that sticks out to you in the latest statement from the Fed?
Well, there are three things that stick out to me in this statement. The first is that the Fed does talk about there being diminished downside risks. Okay, the statement is the committee sees downside risks to the outlook for the economy and the labor market as having diminished since the fall. Okay, that's a change. And that's the kind of thing that would be the first step toward the Fed actually beginning to taper. Okay, maybe it's not enough, but that sends us in that direction.
Why is it the first step?
Well, because the Fed has to find the economy is doing better or that the risks to the economy are diminished before it would want to change policy in a way that's less accommodative.
Sure. Okay?
So the other thing is noting that they're missing their inflation target, and they're saying that it's partly reflecting transitory influences. But yet, when you look at the forecasts that are here, and they've presented a new set of forecasts, we remain below 2% in terms of the midpoint of the committee members' expectations throughout the entire period for which they make projections out to 2015.
Right.
So that's an interesting definition of transitory.
So let's jump over to those economic projections. One of the first things that you noted right before we came on was talking about the federal funds rate out to 2015. What did you see there that stuck out?
Yeah, well, the projections for the members show as you get several years out, some of the high side estimates have come back into the pack. So some of the people who thought the Fed might be raising rates more aren't looking for that anymore. So that's interesting in terms of the projections. The projections are, you look at them in detail, you know, the growth numbers are made a little bit higher, then a little bit lower, then a little bit higher in the out years. But the unemployment rate is lower generally, and the inflation outlook is lower. Now that lower inflation outlook is very interesting because you have the statement in the FOMC statement itself, and you also have at the end of the statement a new dissent. You have James Bullard dissenting, and we have Esther George dissenting. Now, Esther George is not new. She's still dissenting, concerned that the high level of monetary accommodation increases the risk of future economic and financial imbalances and so on. But
sure.
Jim Bullard says, Jim Bullard, who believed that the committee should signal more strongly its willingness to defend its inflation goal in light of the recent low inflation readings. So Bullard and George are going in opposite directions. George wants to do less, wants to get out of this sooner. Bullard says we should do more. And this is very interesting because I completely agree with both of them in their own way.
Okay.
I think that we've kind of overstayed our welcome in terms of all this stimulus. But I think Bullard is right. If the Fed, remember, didn't just have an inflation target, but it raised it, said they could, accommodate expectations of 2.5%. And
right.
Yet the inflation rate continues to go down. The Fed is making a bigger miss on its inflation targets. When you look at their profile of forecasts for GDP, they keep lowering their GDP estimates until this month when it's a little bit mixed. And so amid conditions where they're basically not hitting their unemployment target, where they're not hitting their inflation target, they're going to be less accommodative. Well, that doesn't make any sense to us.
So what's Bullard pointing out here? Is he trying to say that we need more stimulus, or is he reminding the Fed, don't forget about our inflation target?
Well, I think in some sense what Bullard is reminding the Fed is that it needs to be careful of its own credibility. If you promise something, you'd better deliver. And this is one of the problems that I have with this, with the statement, with the policy, and I'm glad to see Mr. Bullard dissenting here because he's completely right. The Fed has an inflation target, they're not reaching it, and what they should be doing is becoming either more accommodative, or they need to explain to us very clearly why that target isn't relevant right now. They need to deal with this fact that they're missing this target, and that missing both targets in a way that should cause monetary policy to move in the same direction. I'm critical of this dual objective because it can cause policy to want to go in two different directions at the same time. But right now, it's the opposite thing. Both things are pushing the Fed in one direction, and the Fed wants to go in the opposite direction. It wants to do less accommodation. Now, of course, it's done a lot of accommodation, so we can kind of understand that. But that's why this gets to be so complicated. It makes arguments about how many angels can stand on the head of a pin refreshing.
So we have Bullard standing out and essentially saying, I don't necessarily agree with the way we're approaching things right now. Does this show the real cracks in the difference of opinions of these central bankers on the Federal Open Market Committee?
Yeah, I think that the dissent between Bullard and George certainly shows that there are differences of opinion.
Okay.
But one of the things the Bullard dissent shows you is how the Fed has got much more than a communication problem. It's got a policy problem. The Fed isn't just not communicating correctly to us. It's communicating to us and then not doing what it had communicated it would do. And this is an issue for the Fed. The central bank has to have credibility.
Okay. Well, Bob, we got Ben Bernanke stepping up, and we'll go to him now.
The Federal Open Market Committee concluded a two-day meeting earlier today. Based on its review of recent economic and financial developments, the committee sees the economy continuing to grow at a moderate pace, notwithstanding the strong headwinds created by current federal fiscal policies. The labor market has continued to improve, with gains in private payroll employment averaging about 200,000 jobs per month over the past 6 months. Job gains, along with the strengthening housing market, have in turn contributed to increases in consumer confidence and supported household spending. However, at 7.6%, the unemployment rate remains elevated, as do rates of underemployment and long-term unemployment. Overall, the committee believes the downside risks to the outlook for the economy and the labor market have diminished since the fall, but we will continue to evaluate economic conditions and risks as they evolve. Inflation has been running below the committee's longer-run objective of 2% for some time and has been a bit softer recently. The committee believes that the recent softness partly reflects transitory factors, and with longer-term inflation expectations remaining stable, the committee expects inflation to move back towards its 2% longer-term objective over time. We will, however, be closely monitoring these developments as well. In conjunction with this meeting, the 19 participants in our policy discussion, the 7 board members, and the 12 Reserve Bank presidents submitted individual economic projections. As always, each participant's projections are conditioned on his or her own view of appropriate monetary policy. Generally, the projections of individual participants show they expect moderate growth, picking up over time, and gradual progress towards levels of unemployment and inflation consistent with the Federal Reserve's statutory mandate to foster maximum employment and price stability. In brief, participants' projections for economic growth have a central tendency of 2.3 to 2.6% for 2013, rising to 2.9 to 3.6% in 2015. The central tendency of their projections of the unemployment rate for the fourth quarter of this year is 7.2 to 7.3%, declining to 5.8 to 6.2% in the final quarter of 2015. Most participants see inflation gradually increasing from its current low level toward the committee's longer-run objective. The central tendency of their projections for inflation is 0.8 to 1.2% for this year and 1.6 to 2.0% for 2015. Before turning to today's policy decision, let me say a few words about the Federal Reserve's strategy for normalizing policy in the long run. In the minutes of its June 2011 meeting, the committee set forth principles that it intended to follow when the time came to normalize policy and the size and the structure of the Federal Reserve's balance sheet. As part of prudent planning, we've been reviewing these principles in recent meetings. We expect those discussions to continue and intend to provide further information at an appropriate time. For today, I will note that in the view of most participants, the broad principles set out in June 2011 remain applicable. One difference is worth mentioning. While participants continue to think that in the long run, the Federal Reserve's portfolio should consist predominantly of Treasury securities, a strong majority now expects that the committee will not sell agency mortgage-backed securities during the process of normalizing monetary policy, although in the longer run, limited sales could be used to reduce or eliminate residual MBS holdings. I emphasize that given the outlook and the committee's policy guidance, these matters are unlikely to be relevant to actual policy for quite a while. Let me turn now to current policy issues. With unemployment still elevated and inflation below the committee's longer-run objective, the committee is continuing its highly accommodative policies. As you know, in normal times, the committee eases monetary policy by lowering the target for the short-term policy interest rate, the federal funds rate. However, the target range for the federal funds rate, currently at 0 to 1/4%, cannot meaningfully be reduced further. Thus, we are providing policy accommodation through two alternative methods. First, by communicating to the public the committee's plans for setting the federal funds rate target over the medium term. And second, by purchasing and holding Treasury securities and agency mortgage-backed securities. Let me discuss a few key points regarding each of these two policy tools. First, today the committee reaffirmed its expectation that the current exceptionally low range for the funds rate will be appropriate at least as long as the unemployment rate remains above 6.5%, so long as inflation and inflation expectations remain well behaved in the census described in the FOMC statement. As I've noted frequently, the phrase "at least as long" in the committee's interest rate guidance is important. The economic conditions we have set out as preceding any future rate increase are thresholds, not triggers. For example, assuming that inflation is near our objective at that time, as expected, a decline in the unemployment rate to 6.5% would not lead automatically to an increase in the federal funds rate target, but rather would indicate only that it was appropriate for the committee to consider whether the broader economic outlook justified such an increase. All else equal, the more subdued the outlook for inflation at that time, the more patient the committee would likely be in making that assessment. In the projections submitted for this meeting, 14 of 19 FOMC participants indicated that they expect the first increase in the target for the federal funds rate to occur in 2015, and one expected the first increase to occur in 2016. Moreover, so long as the economy remains short of maximum employment, inflation remains near our longer-run objective, and inflation expectations remain well anchored, increases in the target for the federal funds rate, once they begin, are likely to be gradual, consistent with the committee's balanced approach to meeting its employment and price stability objectives. The purpose of this forward guidance about policy is to assure households and businesses that monetary policy will continue to support the recovery even as the pace of economic growth and job creation picks up. Importantly, as our statement notes, the committee expects a considerable interval of time to pass between when the committee will cease adding accommodation through asset purchases and the time when the committee will begin to reduce accommodation by moving the federal funds rate target toward more normal levels. The second policy tool being employed by the committee is asset purchases. Specifically, the committee has been purchasing $40 billion per month in agency mortgage-backed securities and $45 billion per month in Treasury securities. When our program of asset purchases was initiated last September, the committee stated the goal of promoting a substantial improvement in the outlook for the labor market in the context of price stability, and noted it would also be taking appropriate account of the efficacy and costs of the program. Today, the committee made no changes to the purchase program. Although the committee left the pace of purchases unchanged at today's meeting, it has stated that it may vary the pace of purchases as economic conditions evolve. Any such change would reflect the incoming data and their implications for the outlook, as well as the cumulative progress made toward the committee's objectives since the program began in September. Going forward, the economic outcomes that the committee sees as most likely involve continuing gains in labor markets, supported by moderate growth that picks up over the next several quarters as the near-term restraint from fiscal policy and other headwinds diminishes. We also see inflation moving back toward our 2% objective over time. If the incoming data are broadly consistent with this forecast, the committee currently anticipates that it would be appropriate to moderate the monthly pace of purchases later this year. And if the subsequent data remain broadly aligned with our current expectations for the economy, we would continue to reduce the pace of purchases in measured steps through the first half of next year, ending purchases around mid-year. In this scenario, when asset purchases ultimately come to an end, the unemployment rate would likely be in the vicinity of 7%, with solid economic growth supporting further job gains, a substantial improvement from the 8.1% unemployment rate that prevailed when the committee announced this program. I would like to emphasize once more the point that our policy is in no way predetermined and will depend on the incoming data and the evolution of the outlook, as well as on the cumulative progress toward our objectives. If conditions improve faster than expected, the pace of asset purchases could be reduced somewhat more quickly. If the outlook becomes less favorable, on the other hand, or if financial conditions are judged to be inconsistent with further progress in the labor markets, reductions in the pace of purchases could be delayed. Indeed, should it be needed, the committee would be prepared to employ all of its tools, including an increase in the pace of purchases for a time, to promote a return to maximum employment in a context of price stability. It's also worth noting here that even if a modest reduction in the pace of asset purchases occurs, we would not be shrinking the Federal Reserve's portfolio of securities, but only slowing the pace at which we are adding to the portfolio, while continuing to reinvest principal payments and proceeds from maturing holdings as well. These large and growing holdings will continue to put downward pressure on longer-term interest rates. To use the analogy of driving an automobile, any slowing in the pace of purchases will be akin to letting up a bit on the gas pedal as the car picks up speed, not to beginning to apply the brakes. I will close by drawing again the important distinction between the committee's decisions about adjusting the pace of asset purchases and its forward guidance regarding the target for the federal funds rate. As I mentioned, the current level of the federal funds rate target is likely to remain appropriate for a considerable period after asset purchases are concluded. To return to the driving analogy, if the incoming data support the view that the economy is able to sustain a reasonable cruising speed, we will ease the pressure on the accelerator by gradually reducing the pace of purchases. However, any need to consider applying the brakes by raising short-term rates is still far in the future. In any case, no matter how conditions may evolve, the Federal Reserve remains committed to fostering substantial improvement in the outlook for the labor market in a context of price stability. Thank you. I'd be glad to take your questions.
What is the first thing, the biggest thing that stuck out to you thus far?
Well, the chairman is giving us some framework for the timetable for this tapering operation. And he's trying to let us know what the Fed thinks is going to happen. He calls this description that he has of starting the end of next year and maybe concluding by the middle of next year with the unemployment rate near 7% as a consensus expectation. It's not a promise. It's not a pledge, but it's based on what the committee thinks is likely to happen given their policies and given the way they think the economy will evolve. So he's just trying to give us some guidance. But we want to be real careful to emphasize what he has emphasized, which is that this is not a hard and fast plan. This is just a scenario consistent with what they're looking for.
Right. It's interesting because John Hilsenrath is the person who asked the question about the tapering. John is often the person who's kind of breaking this news from officials inside the Fed, and the markets react to the stories he writes. Now, Ben Bernanke looked straight at him and said, listen, when we taper, that is based on what happens to the economy. We don't have a hard date.
Right. Right. Well, we call this is a conditional forecast. So the Fed has a conditional forecast. A lot of things in the Fed statement are conditional. And one of the things that sort of bothers me about the way the Fed does this is they claim that their communication helps to lead rates lower, but yet a lot of the things that they're communicating are conditional forecasts, meaning that if conditions in the future are going to be stronger, then they won't be leading rates lower. They won't be doing more accommodation. And you can't really have it both ways. And I think the Fed is basically trying to sell us the same snake oil twice in some sense with this.
Right. He used the car pedal. So he used you let off the gas pedal, but you're in acceleration. Why does he use this example?
Well, what he's trying to explain to people is that if the Fed reduces the amount of purchases, it's still being accommodative. It's like you're overweight and you're eating less, but you're still eating too much. So he wants people to realize that just because the Fed cuts back doesn't mean that it's becoming constrictive. It is less accommodative, but it's still accommodative. So the Fed isn't becoming constrictive until they start selling their portfolio. That's his point. And he said that's a long way off. And he talks about conditions under which the Fed funds rate would rise, which is after they had stopped all of the accommodation, and then he would expect a certain time period to lapse, and he says that's a long way off.
Sure. Now, Steve Leisman kicked off all the questions when he asked Ben Bernanke, well, is what you're telling us like the policy of the Federal Open Market Committee, or is it just one or two people? And he said, no, this is the whole committee. What's kind of the purpose of that back and forth?
Well, because, Ben Bernanke read us this thing about the Fed would likely start tapering by the end of the year. It would likely end by the middle of the following year. And so the question, well, what is this? That's the question. What is this? Where does this come from? It's not in the statement. Where did this come from? How did I miss this? That's what Steve's saying. What is the standing of this statement? Is it something you have said, or is it something from the committee? And the chairman said very clearly that this was a consensus statement of basically the most likely scenario. That's what it is. Likely scenario based on a conditional scenario. But a likely conditional scenario.
Now, this conditional forecasting, I mean, this seems a bit unusual maybe to a point. What do you make of it? Why are they really stressing this now?
Well, Remember, when they started out talking about how long they would leave interest rates low, first they started with a fixed date, and then they moved that date in.
Sure.
And then they moved to this conditional stuff, because some members of the committee said that you couldn't promise a hard and fast date. That wasn't realistic, that would get the Fed in credibility trouble. So this is a more pragmatic way of dealing with it.
We're looking at the fact that there's no change in policy. The Fed continues to try to clarify. I mean, is there a point at which there's just too much that they're throwing out there and it's just confusing markets? One day the market's up because report A comes out. The next day the market's down because report B comes out.
I think that markets are a little bit confused by the Fed statement. Bernanke has tried to suggest that there's a tiered system here, that first they're going to deal with QE, and then they're going to deal with the rate changes, and they're going to come in order, and they're both on the same path. But he's got that going on. At the same time, the Fed has got these policy statements about where they want the unemployment rate, where they want the inflation rate, and they're missing both of those. And it looks like they should be more accommodative, yet very clearly they're still promising or planning to be less accommodative.
Sure.
And this is the nature of the Bullard dissent this month.
Sure. So, Bob, I guess we'll jump into one final question here, and this is less about the policy statement and the economic projections we saw that came out. Jackson Hole in August, typically the Fed chairman comes out, gives some sort of speech. Looks like he's going to skip it this year. Is there any reason why he would do this? And do you think it might relate back to kind of the current policy we're seeing come out of the...
Well, I think that the suggestions are that he doesn't plan to run for another term, and we may be finding that out in the Q&A section. Somebody may be asking them that question right now, and that's what we're waiting to hear, because the president has just made a statement within the last day about how the Fed chairman has stayed longer than he had planned. And that's certainly the first official statement that would suggest that maybe he's not going to stay on. And if he's not going to stay on, then not being at Jackson Hole is a way to create an orderly transition.
Bob, as always, fantastic analysis. We love having you back here, and we look forward to it maybe in the next quarter.
Thank you.
You heard it from Bob. We had a lot of information come out. Not too many changes in the statement. We did have some interesting changes in projections. Keep an eye on the Fed, as the markets always are. I am Joe Dell, The Street.